General Motors just delivered a quarter that has Wall Street buzzing. On October 21st, the auto giant released its Q3 2025 earnings, and the report was a classic tale of two stories. A decisive beat on expectations that sent the stock soaring, paired with some significant underlying pressures that reveal the true cost of its electric transformation. In this video, we'll break down the mixed signals, explain why investors reacted so positively, and what GM's strategy tells us about the future of the auto industry. Let's dive in. General Motors Company is a global automotive giant headquartered in Detroit, Michigan, renowned for designing, building, and selling cars, trucks, and automobile parts. Its core business revolves around a diverse portfolio of vehicle brands, including Chevrolet, Buick, GMC, and Cadillac. With a massive presence in North America, China, and other international markets, GM operates through an extensive network of dealerships. Beyond traditional manufacturing, the company is heavily focused on strategic areas that define the future of mobility, such as autonomous vehicle technology through its Cruise subsidiary and the rapid electrification of its fleet with ambitious plans for numerous new electric vehicles, EVs. Ultimately, GM's business is centered on providing personal transportation solutions while aggressively pursuing its vision of a world with zero crashes, zero emissions, and zero congestion. At first glance, the headlines were strong. GM posted revenue of $48.6 billion, soundly beating analyst estimates of $45 billion. Even more impressive was the adjusted earnings per share of $2.80, which came in 20% above expectations. However, digging deeper reveals the pressure points. Net income fell sharply by over 56% to just $1.3 billion. Similarly, the adjusted EBIT of $3.4 billion was down from $4.1 billion a year ago. So what's causing this profit squeeze? The answer lies in two key areas: significant write-downs related to their electric vehicle programs and costs associated with global trade and tariffs. Despite these profit declines, the market's reaction was overwhelmingly positive, with GM stock jumping over 11%. The primary reason? A surprisingly strong raise to their full-year 2025 guidance. CEO Mary Barra and her team now forecast adjusted EPS between $9.75 and $10.50, up significantly from their previous range. They also raised their outlook for both adjusted EBIT and, crucially, free cash flow, which is now projected to be between $10 and $11 billion. This confident upgrade signals to investors that the core business is fundamentally healthy and that management has a firm handle on costs.
So, what's really driving this confidence? Several key points emerged from the earnings call. First, GM's core North American business remains a powerhouse. U.S. sales were up 8% year-over-year, and the company held on to its position as the #1 automaker in the U.S. by total sales. Second, and most importantly, GM is taking a pragmatic and, in the eyes of many analysts, a smarter approach to its electric vehicle future. While they remain the #2 EV brand in North America, they are deliberately slowing EV production to align with actual market demand. This decision to right-size operations, even if it means short-term write-downs, is designed to reduce losses and improve profitability in 2026 and beyond. Third, the company successfully mitigated about $700 million in tariff-related costs this quarter, thanks in part to policy recalibrations from the White House. This demonstrates an ability to navigate complex external challenges. GM's Q3 2025 presents a company in a controlled transition. The strong raise in guidance, driven by a robust ICE business and effective cost management, provides a solid financial floor. At the same time, the strategic pivot on EVs, prioritizing profitability over pure volume, shows a maturity that the market is rewarding. While the road to a fully electric future may be longer and more winding than initially expected, GM is showing it can manage the journey without sacrificing its financial health. The quarter wasn't perfect, but it successfully rebuilt investor confidence, proving that even in a period of massive transformation, strong operational execution can still win the day. While the headlines about raised guidance are positive, a deeper look reveals a company navigating a complex web of 5 significant challenges. Let's break them down. First and foremost is the massive slowdown in the electric vehicle market. This isn't just a GM problem, but it's hitting them hard. With the federal $7,500 EV tax credit expiring this past September, consumer demand has fallen off a cliff. GM's response has been painful. They've had to cut EV production, and they took a massive $1.6 billion write-down on underutilized factories and assets. The stark reality is that EVs still make up less than 10% of GM's total sales, far below their initial, more ambitious targets. CEO Mary Barra has even delayed the company's goal of going fully electric by 2035, signaling a major strategic pivot. Second is the persistent drag from tariffs. While recent trade adjustments have provided some relief, GM is still expecting to pay a staggering $3.5 to $4.5 billion in tariff expenses for 2025 alone. That's a huge hit to their bottom line. The company remains heavily reliant on imported components and battery materials, making its margins highly sensitive to any future shifts in trade policy or retaliatory tariffs from other countries. Which brings us to the third challenge: profitability, or the lack thereof, in their EV division. The cold, hard truth is that legacy automakers like GM are struggling to make money on electric vehicles. Analysts at Morgan Stanley have openly questioned how GM can achieve sustainable EV profitability when even market leaders like Tesla are facing pressure. The core issue is cost. GM's research, development, and production costs per electric vehicle are still 30 to 40% higher than for their comparable internal combustion engine models. Until they can close that gap, their EV business will be a drag on earnings, not a driver. Fourth on our list are ongoing supply chain and regulatory headaches. While better than in 2023, GM still faces intermittent disruptions, particularly for batteries and electronics. More significantly, they are dealing with regulatory whiplash. Changes in vehicle emissions policies have forced the company to alter its production and investment priorities multiple times already in 2025, creating uncertainty and making long-term planning difficult. Finally, there's the international risk, specifically in China. GM's business there remains fragile. While it's seeing a modest recovery, it's contributing only a fraction of the profits it once did. The company is being squeezed out by local EV giants like BYD and Geely, forcing GM to restructure its joint ventures and focus purely on profitability over market share. So, what does the analyst community really think? Is this a clear buy, or are there significant risks under the hood? Let's break down the numbers, the bull case, the bear case, and the consensus outlook. First, the consensus view. The overall rating for GM is a moderate buy. This isn't a screaming, unanimous endorsement, but a cautiously optimistic one. Out of the 23 analysts we're tracking, you have 1 strong buy, 14 buy, 6 saying hold, and 2 with a sell rating. The average 12-month price target sits at $67.80. With the stock trading around $60, this implies a potential upside of roughly 12 to 15% from current levels. Now, let's look at the bull case. What are the optimists seeing? The bullish analysts from firms like Barclays, UBS, and Goldman Sachs are highlighting 3 key strengths: resilient cash flow and ICE strength. GM's traditional business, especially its highly profitable trucks and SUVs, continues to be a cash cow. The margins here are strong and providing a solid financial foundation. A disciplined EV slowdown. Interestingly, many analysts are praising GM's pragmatic approach to scaling back its aggressive EV rollout. This is seen not as a failure, but as a smart, capital-disciplined move in response to market conditions. And improved execution.
The Q3 beat and guidance raise are being viewed as signs of a credible turnaround in operational execution and management's ability to deliver. This optimism is reflected in some of the higher price targets. Dan Levy at Barclays raised his target to $77 after the earnings. Joseph Spack at UBS has a street high of $81, and Goldman Sachs' Mark Delaney is at $74. But there is a bear case. What are the concerns? The skeptics, like Colin Langan at Wells Fargo, who has an underweight rating and a $40 target, point to one major overhanging issue: EV profitability. The primary concern is whether GM can realistically hit its goal of breaking even on its electric vehicles by 2026. The fear is that if consumer demand for EVs doesn't recover as expected, these operations will continue to be a drag on margins for much longer. The collective advice from analysts seems to be this: GM is a near-term buy, but with moderate risk. The consensus is to hold existing shares or consider accumulating on any market dips. The strong guidance and powerhouse performance of the North American truck and SUV business provide a solid floor and near-term catalyst. However, your decision to invest likely hinges on your belief in GM's electric vehicle future. If you believe they can navigate the path to EV profitability, the current price offers an attractive entry point. If you're skeptical and see prolonged headwinds in the EV segment, you might want to wait for more concrete signs of success. That's the breakdown for General Motors. What's your take? Are you bullish on GM's ability to manage this transition? Let us know in the comments below.